What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
All right, welcome back, everyone. So we are approaching the end of the year, which means time to do some tax planning. I can't hand on this enough. If this is the first time you've thought about your taxes and tax planning, you're failing, to be honest. You're a business owner. You should have hired somebody way earlier in the year. And a lot of times people are like, well, I don't want to pay money. I don't want to hire professionals. One of the best things that professionals can do for you is push up your timeline, push up your planning, force you to do the things that you need to do. I will say, it's great that you're still thinking about it in this year. A lot of people are like, April 1st, taxes are going to be due April 15th. Let's think about tax planning. And a lot is gone. But at the end of the day, right, it is hard to execute on all the tax planning that you want in the last few weeks of the year. So great job thinking about it this year. Next year, let's start to think about it in the beginning of the year, not the end of the year. But either way, lots of good tax planning we can do. And let's just focus in on all of the really big ones. Let's just switch off one by one. But one other thing I want to hit on here is that end of year tax planning is not just buying things. I can't tell you, I just today was commenting with somebody on Twitter and he was like, hey, I got a friend. He just started a consulting business. He's making $250,000 a year. He's surprised by what he's going to owe in taxes. What would you do? Pay the tax or start thinking about deductions? And my comment right away was stop thinking about deductions, right? Because there are good deductions and we should think about them. But what the average person, when they think deductions, they think buy, spend, do, right? At the end of the day, like the least impactful thing that you can do to reduce your taxes is go buy more things, right? If you buy a $100,000 car and you get a 37% deduction, you still spent $63,000 on the car. And in all reality, you're not going to basically depreciate all of that in 1 year anyways. But with the things that we're going to talk about are more advantageous tax planning tools that aren't just about spending and losing the majority to just reduce some of your tax liability. So, Jacob, what's the first one that comes to your mind when we think end of year tax planning?
Yeah, I think the first thing to think about when it comes to end of year tax planning is I would just call it knowing your numbers. So if you're a business owner, first and foremost, like you need to understand what it looks like your net income is going to be, what it looks like the profit's going to be in your business. And then secondarily, understanding with any outside investments you have, let's use the public markets as an example, you need to know what those dividends look like, how many of those dividends are ordinary dividends. Is there, especially with money markets earning what they're earning in recent years, we've had a lot of clients that have earned significant taxable interest in 2024. So making sure that you understand what that looks like. Also making sure that you understood, okay, for 2023, when I filed my taxes, if I got a refund, did some of that refund go towards prepaying taxes for 2024? And on top of that, what have I paid in quarterly estimates? So I think when I think about tax planning, like we're going to talk about all these different strategies, you have to baseline know your numbers, because if you don't know your numbers going into this, like, yes, this strategy might save you money, but you're still going to be confused come next March, come next April, when you're like, I got this surprise tax bill. I didn't know what it looked like. The number one thing I just cannot stress to everybody enough is know your numbers.
I think that's perfect. Tax awareness is like the first step of tax planning. What do you owe? What do you have going on? And then from there, you can figure out what you really want to do. So I think that's a great starting point. And just so everybody knows, this is really geared towards business owners. There are going to be a lot of similarities here to non-business owners, but this is geared towards business owners this episode. So for me, the first one that comes to mind is maximizing the qualified business income deduction. For those of you that didn't listen, last week was an entire episode about maximizing the qualified business income deduction. So know that it's either 20% of business profits. Once you make above 483, it's the lesser of 20% of business profits or W2 or 50% of W2 wages. So at the end of the year, you really need to think about as you make decisions, right? We just talked about spending and buying more. I see it all the time. People spend and buy more to reduce their taxable income, but they reduce profit by doing that, and they reduce the qualified business income deduction. So we won't spend too much time on that one because we did a whole episode on it. But I would say of all of the tax planning, this is number one or two of most impactful thing to be focusing on.
Easily number one. Especially for the clients we're working with, it's the biggest tax deduction that they're going to have, and it's the one that so often gets missed.
The only reason I would say it was two is because retirement accounts are right there, right? Like if you do,
But I think more people nail retirement accounts, which let's talk about retirement accounts real
that's
quick. So
fair.
when we say retirement accounts, qualified accounts, this is something that I think a lot of people at a baseline understand. So typical retirement accounts that you're going to see as a business owner would be either a traditional 401k through your business. One thing to understand with that is nowadays there's more access than ever to a potential Roth 401k option there. Depending on how your business is structured, potentially looking at doing a solo 401k as well, where there's going to be some sort of profit sharing. You can get up to $69,000 in 2024. In addition to that, one episode that we did earlier in the year was on cash balance plans. So depending on how your business is set up, depending on how your employees are set up and structured, that could be another huge option for you to potentially defer a bunch of money. And Thomas, to your point, qualified plans can save somebody a lot of money. I think first and foremost, people are probably more aware of qualified plans, and I'm not saying they do them right all the time, but there's more general awareness of them than I've seen with QBI. And I think it's one thing to just make sure that people understand with qualified plans, they're not all the same. Okay, so you need to understand in your specific situation, like one, are you looking to defer taxes now, i.e. traditional qualified plan, or are you looking to potentially get a bigger tax benefit in the future, which would obviously be more of a Roth type situation?
And you can combine it too, right? Like a lot of my clients who are like earlier on in their business, or maybe it's a side business, they're doing pre-tax solo, doing the employer solo, and then they're doing mega backdoor to fill up that room. Or I have some clients who are actually doing cash balance plan, and then with their solos, they're doing mostly Roth. Right now, we have a good mix of the two, but just naturally, who I work with a lot of people making seven figures, deferral makes sense because it's going to be really hard to be in a 50.3% effective bracket when, almost a quarter of my clients are in the state of California. But I do think retirement accounts are great, right? Make sure you max out the employee side. So that 23,000 you have to have done in this calendar year. The employer side, so that could be, it's basically profit share or just the employer side of a solo. So employer side of solo is either 25% of W-2 wages or basically 20% of business profits. And then for a 401k, you can do a profit share on that as well. And so you can basically carve out a pool and do it proportional to income. You can do equally for everybody. But the one thing I really want to hit on here is use it, max it out. Like at the end of the day, if you make a lot of money, you should be maxing out and utilizing either pre-tax or Roth, because you still should have a lot of room for taxable investments at the end of the day. And the other thing is, this is a great time to audit your retirement plan. I'm telling you, if you have a simple IRA, get rid of it. Just get rid of it. 401ks are literally just better in every way. Higher contribution limits. You can actually do a profit share. They're really not more expensive to have or administer anymore. If you have a SEP IRA, same thing. Get rid of it most likely and go to a solo 401k. Reason is because solos are better. They have the employee side plus the employer side. SEPs only have the employer. And then once you have employees, you have to do the same percentage of your income in a SEP as everybody else, which means people then stop contributing a lot to themselves, when in reality, they could have then moved to a 401k and get the full employee side and then just have the match.
No, 100%. I think on the qualified side, the biggest thing is don't listen to social media that says that qualified plans are not good. But at the same time, I think we do need to be conscious of the fact when Thomas and I are talking about different strategies, you need to understand we're coming from it from the lens of working with high net worth and ultra high net worth clients where there's a ton of money that they're saving. If you're saving $69,000 in a year, you are most likely in the 1% of people saving money. Okay, so that's a ton of money. But if that's the only money you're saving, I would just be cautious. It might not all make sense to go into a qualified plan, even though you're going to get a tax benefit. So just be aware of that context as we're talking through this. So Thomas, outside of, go ahead.
In here, don't only reduce your taxes because you see your tax bill. You'll see people are like, I've never made 200K. I got to reduce my taxes. Well, if you're early on and you're starting to make 200K, you're probably going to make a lot more, and your income's going to go up. Taxes are going to go up. It might make sense to do Roth for you. Like me personally, I'll be in the 35, almost 37% bracket this year, but I'm really young. So I'm doing all Roth dollars first. Roth 401k, Roth IRAs for me and my spouse, because I know I'm never going to get any pre-tax money in if I start this young, and my income's only going to go up. So you have to really think through a lot of parts here and understand that lifetime tax mitigation is more important than this year's tax mitigation.
Kind of like planning is important.
Exactly. Exactly.
All right. So we've talked a little bit about knowing your numbers. We've talked about QBI. We've talked about qualified plans. For me, I think the next one that I always think about that we talk with clients a lot about is donations, right? So how do we maximize potential donation strategies before the end of the year? And I think one thing that we've harped on a lot is something called a donor advised fund. So what a donor advised fund allows you to do is group together donations in a year that you potentially have a very large income and be able to maximize the tax benefit. The other thing, though, that I would say specifically for business owners that I see a lot is we'll get a business owner and they'll say, well, I'm giving money and I'm giving out of my business, right? So I'm already going to get the tax deduction, so I'm not worried about it. And the one thing that I would just caution on that is if you are doing a donor advised fund correctly and you have your accounts outside of it structured correctly, I would say, and you have any sort of appreciated stock, you're going to get a bigger tax benefit by giving away that appreciated stock, putting it in a donor advised fund, and then giving it through the donor advised fund, or granting it out is what they would call it, as opposed to giving out outside of your business. And the quick example I would give is if you bought Apple stock for $1, it grows to be worth $2. You put in the entire $2 amount into your donor advised fund. You pay no taxes on the $1 gain. So you're getting essentially a double tax benefit. You get the $2 donation benefit, plus you get that $1 benefit of the gain where you're never going to pay taxes on it. So if you're a business owner out there and you are charitably inclined, you need to understand what a donor advised fund is. And I would just caution giving too much money out of your business because there's probably a better way to do it.
Yeah, I think people think that it's more advantageous coming from their business when it's a pass-through entity. It literally doesn't make a difference whether it's through your business or through personal, but you have to itemize to get this, right? If you have 10,000 of deductions and you give 10,000 and you're married, you're getting no benefit from charity by doing it that way, right? That's where it starts to make sense of like, hey, let's do 3 years at one time. But I agree, donor advised fund, every single time, pretty much, if you have investments. If you don't, you could actually accelerate or wait and do 3 years into a donor advised fund of cash. The other thing is you can donate stock directly to a charity if that exists as well. So up to you. At the end of the day, it's a really great planning move. And I want to talk about Roth conversions because I want these two to go hand in hand. So end of year is a really good time to consider Roth conversions. I have a ton of clients we're doing Roth conversions for. I have a ton of clients that we plan to do Roth conversions for, and we're no longer doing it. So at the end of the day, for me, for most high income earners, if you have room through the 24% bracket is really where I think Roth conversions often make a lot of sense. So, maybe you sold a business last year and you're building a new one. Maybe this is your first year in retirement. Maybe, only one spouse is working and you've lost a lot of income in this year. You can convert pre-tax assets to Roth by paying the tax, basically. Why that's good is you defer up here, you fill through here. If you can lower that effective tax, it's really, really great. You always want to wait till year end. Perfect example is I had 2 clients we were going to do it for this year. One of them retired. He just got an awesome job. He's going to make a stupid amount of money. And what we thought he was going to have a ton of room in 24, no room at all, not even close. Another one started a business. They've sold multiple. This year they're going to have 0 income, got a really good offer at year end, getting a huge signing bonus, and he's going to end up being way into almost 35. And so when that happens, you're going to regret if you ended up doing the Roth conversion early and you basically just locked in a tax that you really didn't want. However, you want to say something?
You might say it. I'm going to let you say your part. And then
I was just going to say, however, I have some clients who they were going to have a decent amount of room in 24. Maybe now they ended up starting a job at year end and they only have like 30,000 of room left. But because they're very wealthy, one thing that we're doing is we're creating more room through a donor advised fund contribution. So what they're doing is I've been trying to diversify out of my employer stock. It's up a lot. I don't really want it. We have plenty of wealth, way more than we ever need. Great. This is a good year for me to have Roth conversions because every year moving forward, income's now going to be back to higher because they're only working for like a quarter. And so what we're doing is we're donating their company stock, right? So 30,000 of cost basis, worth 100,000. They got $100,000 deduction. They avoid the $70,000 capital gain. And now because of that deduction, they have what's room left in 24 plus that whole donor advised fund contribution because it reduces your taxable income. And so now instead of only being able to do a really small amount of a Roth conversion, they're able to do a pretty large Roth conversion and get over 25% of their pre-tax accounts moved to Roth in the 24% bracket.
I love the idea of combining 2 of those strategies there. And it goes back to what we talk about a lot, just being proactive around the tax planning. The only other nuanced thing I would add to that is the only other time I've seen Roth conversions make a ton of sense earlier in the year, and they wouldn't have made sense this year, but as if the market does have a significant pullback. So a couple of years ago, the market had significant pullback, 20+%. that can be a time where you could say, hey, I'm going to take the chance that I might be in this bracket, I might not be, but I know I'm going to lock in this 20% asset value that's a little bit lower than hopefully it's going to be in the future. So for somebody thinking about this, not just for this year, but for future years, potentially looking at Roth conversions, also understand what is the asset value that you're potentially converting. If the market is in a situation where it's a little bit depressed in value, could make sense to do that potentially earlier in the year.
And that's a horrible time to do donor advised fund contributions when the market's down as well. So like all of these things you want to think through and try to have the best timing you possibly can. It's never going to be perfect, but you have to take some best guesses.
Yep.
Okay. What's the next one you think of?
So next one I think of is a little bit more nuanced, and it applies to business owners, but it applies more so to their investment portfolio. We talked a little bit about reviewing their 401k plan to make sure that like you're doing it right. Okay. Simple IRAs, like let's just get those out of there. Hashtag not financial advice. When I think about investment portfolios, one thing I think about a lot is on the taxable side. So not on the qualified side, people that were maybe working with a financial advisor and built out an investment strategy in the past. And they're like, you know what? I don't love the investments that I have today. And this is something that we see time and time again at the end of the year. So mutual funds, okay, so any sort of fund that you own that's not an ETF is most likely going to pay some sort of capital gain distribution. Those capital gain distributions come out around this time. So they're not actually hitting your account right now. But typically, if you own some sort of mutual fund, the mutual fund provider will be able to give you a list of, hey, XYZ mutual fund is going to produce XYZ capital gain. That can be a really good time for you to consider, hey, if I'm going to move out of this account in the future, understanding, hey, what are the tax consequences of this capital gain distribution going to be, and potentially making a change in your investment portfolio before that happens. Again, this is something that's very nuanced, but I think for a lot of business owners at start, in terms of my goal was to make payroll, now I'm making way more money than I ever thought. And the way I was investing 10 years ago maybe doesn't reflect the way that I want to be investing moving forward.
Yeah, that's a good one. I think going in with this inside of that account is tax gain harvesting, tax loss harvesting. And I think a lot of people like tax loss harvesting, the market's up, 25% this year. Who's tax loss harvesting right now? A lot of people with individual stocks. Clients come in, we do first meeting, and we're like, drop it. Like, get rid of Disney, like get rid of some of these stocks that have done really terrible. Take that tax loss. And a lot of times people are like, well, I don't want the loss. What if it comes back? Well, if you're worried about that, sell it, buy it back in 31 days. Very unlikely that in that 131-day period, it's going to recoup so much that it's not going to benefit you. But for the high income people we work with, banking losses is really impactful. Why? Because they're going to have a ton of gains on the line. They're selling businesses. So as much as you can, take those tax losses when they're there. And when it's like ETFs or mutual funds, go buy a very similar fund, not identical, obviously, right? If it's a stock, you can buy a correlated one for 31 days and go back, or you can just be like, all right, like a lot of my clients do be like, I liked picking stocks for a while and I realized I'm horrible at it. Like most people statistically are bad at it. Then get out of the game, reinvest your portfolio, move on, right? Take your loss, let it benefit you and move on.
Yeah, 100%. All right. So outside of the investment portfolio, what comes to mind next for you, Thomas?
I think, the HSA is probably the next one for me, right? Like if you look and you haven't maxed out your HSA, I would go get that done. A lot of times people end up just short. They didn't really notice. They didn't ever change it from the last couple of years. So they're based on lower contribution limits. But one caveat here is just make sure you know what your employer puts in. You'll see people all the time be like, oh, the max is X, right? And they don't realize that you can only get in what you put in minus the employer or total contribution yearly limit minus the employer match gets you what you do. Unlike a 401k, right? 401k, you can do 23,000. The match doesn't matter. But within an HSA, the employer match does matter and reduces what you can put in.
I think for me, as I think about the next opportunities, I think more so almost like long-term opportunities for people that have businesses. And I think there's really two different scenarios that business owners fall into here. Scenario one is they're looking to scale back their business in the future. And if they're looking to scale back their business in the future, the way that we're always thinking about tax funding for our clients is future year benefits versus present year benefits. So a future year benefit is we're focused on a lower tax rate this year. And we're saying, hey, what is the benefit that we could get today? Or what is the benefit that we could get in the future because we're in a lower tax bracket today? That could be something like a Roth conversion, right? Versus a current year benefit of saying, hey, we're in a really high tax bracket today. What are things that we should be thinking about to potentially defer taxes? I think if you're a business owner, one thing that I would ask yourself when it comes to tax planning is am I looking to continue to scale my business, or am I looking to potentially scale down my business in the future? Because I think as I think about the end of the year, that can be an opportune time for you to start thinking about what are some of those bigger moves that I can make. One big move that we've talked a little bit about, Thomas, is QSBS. So if you are an S Corp, for instance, and you want to move to a C Corp and you want to potentially sell your business in the future, it's an opportunity for you to say, hey, the business has changed a lot, and I think we have a really good chance of potentially selling this in the future. This is a long-term tax planning move, but it takes you being thoughtful around how my business is doing today and where I want it to be in the future.
Yeah. And I think, what some of the things I wanted to hit on is like not necessarily tax planning, but thinking through future tax planning. And so like picking the right entity and evaluating if it is still the right entity is a really good one. Because for example, one of our clients we just met with and they're like, great, my company's killing it. We basically have a service. The tech that we have to use in this industry is really bad. We want to build a piece of tech. We have the money. We know who can build it. We want to do it. And if they didn't reach out, they would have just started this under their company, come to realize this is a great S Corp, what they currently have. This is a great C Corp, right? So we should not be putting these two together. We should launch this in a different way. And so like you do want to evaluate it right now. For a lot of people, be like, oh, my business grew a ton. I need to become an S Corp because I'm getting nothing from the qualified business income deduction, right? Caveat, that could go away. So maybe you don't want to make that choice in this next calendar year. But I do think evaluating your entity is a great thing to do at year end, and also just reviewing your books and making sure everything is correct. I cannot tell you how messy most business owners' books are. They come into us and we're just like, new CPA, let's get this fixed. I think most times bookkeeper CPA duo or in the same company is really what you want, because if you just are messy in your business, right? I have clients who they came into us and they're like, investing in their taxable account through their business. They're paying for bills through their business that are personal. You just created this whole thing where you have to be so good at communication with your bookkeeper, and you don't want to be. So the way around this is don't do that. Send the things to your personal account that are meant to be in your personal account. Pay for things in the business that are meant to be in your business, because when you go hire a cheap bookkeeper, they're not going to reach out and say, hey, how come you have $200,000 on your P&L for retirement accounts, but you're a solo business, right? That's not doable, because that's not really what they're trying to do. They're just trying to get the work done, do it, move on, make sure everything is clean. And if that's not what you've done so far, make a commitment for that next year.
Yeah, the last one that comes to mind for me is, and something we touched on at the beginning, I think that gets overblown, but I would call it investing back in your business. Let's play out a scenario that your business has had the best year you've ever had, or a year that far exceeds what your expectation was in January. And there might be some tools, some technology, some things that you could purchase that could either better your lifestyle in the business or actually help the business in the future. The caveat to that is they actually need to be helping the business. Okay. Don't just go out and buy something because you want to go buy something. If you watch Grant Cardone and he goes and buys a jet and you think that's a good idea for you to buy a jet, again, if that could really help you in your business and it makes a ton of sense to do it, maybe, right? But if you can invest back in your business and maybe you've had a great year and the cash is there, I think this is a great time for you to be thinking about what are those additional investments I want to make? Because again, as business owners, you don't know what the next year is going to look like. Yes, it looks like everybody's going to continue to make money, but the reality is every business owner in the history of the world thought they were going to make money the next year. And sometimes that isn't always the case. So if you've had a great year, starting to think now about, okay, what are those potential investments that might make sense for you to make that I can also capitalize on a potential tax deduction on?
Yeah, really good point. Okay, I have a few, so I'll just like really quickly hit on them. So one that comes to mind is, maxing out 529. So like in certain states, right, you want to get it in the right year. So like Indiana, $7,500 is the max and you get a 20% tax credit, right? You don't want to wait till January and be like, great, I'm supposed to be I'm going to do 2 years in one, because you missed that credit. Other states, there is a deduction and it doesn't carry forward. So if you over contribute what the deduction is, nothing happens. In some states, if you over contribute, it does carry forward. So you just want to be aware of that for your state. Next one is just considering PTET. There's a lot of business owners I work with that their CPAs have never brought up PTET. You need to elect into it early in the year. So like if you're not in PTET and you have state taxes, make sure you reach out to your CPA and bring that up. So that way you can elect into it early enough. Dependent care FSA funds, if you have funds that are there, make sure you use it, because they're use it or lose it. If it's an FSA, same thing. A lot of times you can carry over zero. Sometimes you can carry over a little bit more, but there's websites where you can buy like products and certain food and like other different things. So I would look into that. I would also look into like estimated tax liability. Are you going to hit safe harbor? If not, running a payroll like we talked about in the last episode and withholding taxes is a really good one. And then, the last two is cost segregation studies, right? Maybe you have properties that have been put into place. Bonus depreciation is going down. If you're going to have a lot in profit, maybe you want to do cost segregation study on some of those investment properties. But understand, if you're not a real estate professional, you're not hitting short-term rental loophole requirements, then you're not actually benefiting from it if you don't have other passive gains. And then the last one is just using your annual gifting limit. For a lot of high net worth people, they're going to have estate taxes. And one great way to move money out of your estate without using trust is just like give the 18,000 to your kids, give it to grandkids, help potentially your parents. But in general, that 18,000 is per year, per person. So as a couple, you can give 36, or you could give 36 to each spouse of your kids. So there's a lot of good things that you can do there. Just moral of the story here is a lot of good tax planning. And this is why you shouldn't just think about what to buy, because we just totally rattled off like so many good tax planning moves. And this is where we think you should focus, not just on buying X, Y, and Z random thing that you probably don't even need in your business.
So this is another point, just to kind of wrap up this episode, is a lot of the things that Thomas and I are talking about, think about them like puzzle pieces. And oftentimes you might know about one or two puzzle pieces, but having somebody else come in and give you a fresh set of eyes on your business and on your financial situation, so many times I see this uncover another puzzle piece. And a lot of times the people that I know that we're working with, specifically Thomas, I know it's probably the same for you. Like, these are super sharp people. They might even know the tax strategy that you're going to tell them and say, oh yeah, I've heard of that. I didn't even think about that this year. Like, that does make a ton of sense. Like, we should totally do that. And I think that's the conversation that we always come back to. Like, these are really smart folks that we have the opportunity to work with. And a lot of times it just is uncovering those extra puzzle pieces because you have a different set of eyes on it to be able to say, hey, because we did this, we need to do this. You mentioned the donor advised fund with the Roth conversion, right? Maybe they thought of the Roth conversion, but they didn't realize, like, oh man, I should capitalize on a donor advised fund to reduce the tax bracket this year.
Yeah. And I think that's the big value that we have, right? Like just last week, I had a client who I've been trying to meet with. We've met a decent amount of times the last 6 months, hasn't been able to meet very often, been super busy. And he emailed me and said, hey man, like, should I pause this service? Like, I haven't been able to meet with you in probably 6 months. And I think, mid next year, things are going to get a little less busy. And I emailed him back. I said, you can do whatever you think is best, but I'm going to challenge you to take a week to think about this and think if actually next year is going to be less busy. I'll tell you, I've worked with a ton of people. Nobody's ever gotten less busy the next year. If anything, they got more busy. If you're not going to carve out the time to deal with your finances with me, you're not going to carve out the time to deal with your finances by yourself. And he emailed me back and he was like, dude, that was one of the best responses I've ever gotten. I figured out, like, my wife needs to be more involved. I need her to help make sure everything gets done. She's super organized. Let's bring her into the picture. And the reason why I think this story is valuable is because what we do is we force time and thought around finances, right? And that's actually really valuable because for most people, they're busy. They have their kids. They have multiple businesses. For a lot of the people that we work with, they still want to have hobbies. They still want to enjoy their life. It's very, very hard to carve out the time to do it. What I see is I'm asking clients for all the details, all the notes, all the documents we need at year end. And it's hard to get them to actually do that. If you can't get that done, you're not going to put in your own thought, do your own tax planning, get all your investments right, like check the box on everything. And so that's you're struggling to get everything done. That's why people hire us. It's the same reason why you hire somebody to do all the roles in your business, right? It's because you can't do them all. And having somebody dedicated doing them leads to better results and things actually getting done.
Preach.
Well, all right, guys. Thank you for listening. Again, end of the year, get your tax planning done. Also, start doing it earlier next year. But thank you for listening. Please rate and subscribe. We'll see you back next week.